Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for May 31st of 2026. So we're going to start off this week after a week's absence talking about economic growth and the GDP number. We got the first reading of GDP at the end of April for the first quarter, and it was about 2%. Now we're getting what we'll call the second revision or the second estimate of that number. We just got that this past week, and it was a little bit below expectations. We were expecting to be flat at 2%, came in at 1.6. It was a little bit lighter. Looking at this chart gives you some detail on that. So this is the progression of economic growth over the various quarters going back to 2022. We can see in the latest number here, again, we were at 1.6, a little bit better, obviously, than the fourth quarter of 2025. But the puts and takes in all of this, really, we had net trade that was a drag, and we also had residential investment that was a drag to a lesser extent. And then we continue to have personal consumption, which is beneficial to our growth. But as you'll see here in that blue splotch, and we'll talk about that here in a couple slides, that has been coming down. So we want to watch that. And then outside of that, we got business investment, which obviously capital spending for hyperscalers on artificial intelligence and the whole AI theme continues to run apace. And then we have government spending here, which was positive, and then to a lesser degree on inventories. But we look at the contribution and kind of break that down a little bit. Again, my point was we got slowdowns in personal consumption. Business investment has been offsetting that and has really been saving our bacon from an economic standpoint. And we know that housing is a drag, and it's really odd to have housing in such a funk and still be in an expansion mode economically. Usually housing is a very strong influencer of growth when you are in an expansion. But government spending, we've got post-shutdown spending. This number I think will become less impactful over time, certainly when we anniversary those shutdowns when we get towards the end of this year. Exports were positive. We do like to see that. Unfortunately, imports rose at a much greater rate, hence the net trade negative benefit there. And then inventories was slightly positive here in the latest quarter. So looking at this a little bit differently, we've got the contribution to the overall GDP number, which again came in at 1.6, slightly below the estimate. Where we had beneficial impact was from consumption, a little bit lighter than expected. Most of these elements came in pretty much in line. So if you look at business investment, again, one of those things, like I said, is really saving our bacon from an economic standpoint. And if we ever have a hiccup or slowdown or a real change in business investment and in particular AI spending, that's going to really hurt our economy over the near term because we're not getting any benefit from residential investment, and then government spending is likely going to, and this is going to play out over a number of years where government spending, you're going to have this crowding out effect to some degree because you've got interest expense that's moving higher. You've also got a crowding in of entitlement programs. And, again, unless you're just completely predisposed, which unfortunately we are now, just to print more money and to create more debt, then that number is likely to be less impactful in the years ahead. But again, exports not being able to offset imports there, the drag from imports, and then inventories we talked about. And if we look at growth rates, again, this is really something that we need to focus on. Business investment, again, this is why we're able to continue this expansion in very large order here. Year over year numbers in residential investment, we've talked about already. And then here we've got imports and exports, but we have net negative benefits from trade. Final point on GDP here is just a multi-year trend that we're observing. If you go back to 2023, and obviously these are all actual numbers that we've closed the books on, 2.9, 2023, That slid, about 10 basis points here to 2024, and then we had 2.1 last year. And again, that's our first quarter. Second estimate of that first quarter GDP number, but nevertheless represents a year-to-date number. Now, we do get the first estimate of the second quarter GDP number at the end of July, and that'll be very interesting to watch. And so here we have 1.6, and just to highlight that, what we've been watching here over, the last several years has been a decline. I think, heading into the year, we're probably looking for something that felt a little bit more like 2025, and that maybe the slowdown happened in 2027. But again, too early to tell because that's only one quarter's worth of data, but just highlighting a negative trend there. Here we have consumer sentiment. We know it has been weak. We've talked about it a lot. We've got two different readings here. In this amber line, we've got the University of Michigan number, which is much more influenced by inflation expectations. And when you think about consumers are responding to the survey, when the questions are asked about inflation, obviously they see it at the pump, they see it at the supermarket, and so there's no surprise here why this number is so weak. In fact, it's historically weak, and you can see here when it is generally weak. Again, the amber line, you typically foreshadow recessions. Now, we don't see that yet because we have such strong business spending, and we also have this K-shaped economy where the upper income cohorts are actually doing quite well, and they're really helping to support our spending. We actually have a chart on that later. So that's the amber line. That's the University of Michigan consumer sentiment number. We also have the Conference Board number as well, and that's also trending lower. Again, these things happen in a very cyclical pattern. You got both of these moving down. It typically does correlate, when you have both of these moving down, at some point you wind up in recession. Right now, the probability of that is not significant. We do have positive economic data, which is offset negative economic data, but we do have higher inflation, and we'll talk about that here coming up. Now, when we think about the factors that could lead into a recession, usually you have to have all of these three things moving in the adverse direction. Right now, we only have one. Real residential investment, we've talked about this at least a couple of times today so far, that has been decidedly negative. However, you've got durable goods consumption that continues to be positive, and this is actually a very encouraging number when you look at this chart, or time series, I should say. And then business equipment investing, you certainly see that. This is the capital spending number for hyperscalers, but it represents technology investing in all of the related impacts, computing power, et cetera. And so these two things are working really well right now. This is not, but you generally need all three of these to kind of get into that recessionary period. Now we'll talk about personal consumption expenditures. So this is the Fed's preferred measure of inflation. You've got numbers that in both the full number as well as the core number, which backs out food and energy, they were just a little bit below expectations, which I guess in a microcosm is good, yet is still in really both of these cases represent kind of elevated points. So particularly the headline number, it was 0.4%, about 0.25% here on the core. So if you look at this in various different slivers, if you just look at it just that 1 month, and this is the core number, and you just look at it 1 month, you're getting basically about 3%, a little bit less than 3% annualized inflation. If you take the last 3 months and annualize it, you get about 3.8, and the same deal if you take last 6 months and annualize that. But you can see here, we were making a lot of progress. We kind of got to a stall point, and now we're moving back up on inflation. This is what will be, this will certainly be a very active topic of discussion over the next 3 to 6 months. If we visualize that a little bit differently and we take this time series back to 2021, post-pandemic, We had the inflation surge, very well understood, and obviously monetary and fiscal policy contributed to that. We're making a lot of progress. As I said in the last slide, we got down to a low point of 2.6, and we thought maybe we were on our way to the 2.0% Fed target. But that has gone back up now. In fact, in this slide, we've had 62 rather consecutive months above 2%. And so in this light, the Fed really has lost a lot of credibility in being able to manage that particular part of the dual mandate of stable employment and stable prices. They just flat out have not executed on that. And maybe that 2% target needs to be revised. And I've been saying that for quite a while. Here we have personal savings, and that is something else that is, on my mind as well. So you got personal savings rates, which, you've got this long-term average here going back, basically before 2000. It's about 5.6, 5.7%. And again, this is cyclical and it moves around. I'd forget about this. This is just stimulus checks, and that was just kind of a definite aberration. And then this is kind of like the offset to that. But then we got to a point where we had achieved kind of an acceptable savings rate, but we've been spending out of that. So, like recall in that first slide, personal consumption has gone down each of the last several quarters. And you've got this going on in tandem. You've got lower savings rates in addition to. So you're supporting a weaker base of personal consumption on a declining savings rate. And we know credit card balances are moving up. And so at some point, I think we see that personal consumption number. It just has to slow because you're going to bump up against debt levels. You're going to bump up against being able to service that debt at the consumer level, so on and so forth. And this is really, in particular, is hitting the lower income cohorts that are facing the higher inflation rates right now. So this is very interesting. I saw this in one of the feeds that I get. So basically, this is the share of U.S. consumer spending by income percentile. And this is what I've actually been saying for a while. You have declining spending on the part of the bottom 80% of the U.S. Consumer cohort here. And you have the top 10% that has just gone nuts. And this, if you just put a up and down line here, there's your K-shaped economy right there in a nutshell. And this used to be flip-flopped. You used to have, you go back to 1990, and you kind of go back about 25 years, and you could see that there was a lot of kind of parity between those income groups, and basically you had a broader based consumer economy. That is not the case anymore now that you've got that decline here, and you've got the top 10% that is really supporting the consumer spending and the consumption that we see out there in the economic data. Beef prices, not a surprise here. We've been watching this for a long time. I brought this up a few times. I think this is really the proxy for what's going on with the bottom 50th percentile of the consumer market. And they're not buying as much beef because it's more expensive. You can see basically, you go back to 2023 and you go back less than 5 years, and this thing's doubled already. And this is very emblematic of a lot of elements within the food basket. Coffee, there's a lot of things that have gone up quite a bit in a relatively short period of time, putting a pinch on the lower income cohort. Real disposable income on a monthly basis, we've been talking about this. The last 3 months have been negative, and you can see for a long time we've had just a little bit of noise here. Last year, and these I kind of look at as being offsets, and then we also had some, maybe some tariff impacts there. But this is something that gets your attention, and when you look at it on a trend line basis, this is the year-over-year number, which is negative 1.1% here. And if you look at it on a monthly basis and annualize that, it's even worse. So real disposable income is going down, and so when we look at consumption and going down in tandem with that, then it's something that gets your attention. Here we have prices of goods. So we've already shown you the beef prices. You've got clothes and footwear, again, moving a little bit higher. You have higher overall levels in furnishings and recreational, sporting goods, so on and so forth. And auto vehicles kind of staying level. Now, we've already talked about net negative residential investment. You've got home price appreciation as something else that you typically don't see when you're still in an expansion mode, however, lighter that might be relative to history. But again, you've got home price appreciation, which has been in decline for some time. You actually have, when you look at inflation adjusted, you're actually negative now. You're still positive when you look at it on a nominal basis, but clearly in a pace of deceleration. Money supply, which we knew went up considerably. You've got various issues that are contributing to that. And we're basically looking at M2 money supply about $23 trillion. And this has been supported by, not only, you've got, fiscal, but you've got, a very easing bias, and you've got quantitative measures that have been used by the Fed to help grow that money supply, notwithstanding the stimulus checks and everything else that goes into this. When you look at, the inflation that we had back at, 2022, you can see that how incredibly, rapid we grew money here. But we're doing that again. We've got increase in Treasury issuance. We're borrowing to expand our government spending, which is taking us into fiscal deficit. And so when you look at this is just kind of the general feedstock for continued high prices, unless we can really unilaterally get a handle on this from both a policy level within Congress, which is a little bit doubtful, and Fed, which I think could be the case with Kevin Warsh, because he has a real strong desire to want to reduce the balance sheet of the Fed, which would certainly take a fair amount of juice out of that. Now we have interest rate costs, which we know because interest rates are higher. They're moving ahead of basically, what we've seen in prior years. And this is, basically cumulative interest costs. And this is like basically $1.1 trillion here, trillion dollars here. So you can see that we're outpacing the prior years. And you can see how the net interest cost has gone up each year of the last. And you can see, like, basically, when you go back to 2020, 2021, we're basically around $300 billion of interest. I mean, 2025, we were basically over 800 billion. Now we're looking at something that could eclipse $1 trillion. And you think about that, that's 3x where we were 5 years ago. Interest costs, again, looking at that kind of a different way, it just consumes more revenue and output. And, and this is basically, looking at market rates and say, like, if we have higher rates that are, higher than where we are now, if interest rates continue to move higher because of inflation, you're basically going to be 30% of revenues. Your interest costs on the national debt are going to be 30% of our national revenue. Just think about that for a second. And then when you think about, like, as a percent of GDP, I mean, that could be 5% of GDP. That is extremely, a significant jump when you look out over the next 10 years. And so obviously, this is kind of looking into the next generation a little bit. And, none of this on this chart is really going to impact us like in the second or third quarter, but it's something to pay attention to as we kind of plot out the next generation. And importantly for our business is how we go about planning for our clients. Now we have semiconductor stocks that are just like going through the roof here, and that's really inflating. When you consider the S&P 500 is now dominated by technology, and the fact that semiconductor stocks have done quite well. Again, no surprise why the index is done, but it's not a broad-based increase by any stretch of the imagination. And this is the ISM manufacturing PMI, Purchasing Managers Index, which is moving higher. Typically, these things, as you can see here, are correlated. So this is, I guess, in a sense, good foreshadowing because you're clearly seeing a little bit of expansion when it relates to technology and especially semiconductor manufacturing. Data center capital spending, those estimates continue to move higher. This is the consensus forecast, which again, looking at basically over the last 12 months, you can see how it's moved higher. Now we have S&P 500 Info Tech. Again, we've been talking about technology spending being a big contributor to overall business investment, which we saw was a strong benefactor to overall economic growth in the first couple of slides. You can see really this is not a new phenomenon, but is really powering economic benefits right now. So you got the sector capital spending and technology that is far outpacing the rest of industry right now. So international stocks, we're going to kind of get into the stock market here a little bit and maybe fixed income. International stocks have done better this year than domestic stocks. Even with the overall rate of gain in the S&P 500, the international diversification has benefited portfolios. We look at the difference between artificial intelligence and the rest of the S&P 500. So this is really the kind of, I'll call it the K-shaped market because you've got the, essentially, you got the AI-linked firms here that have done exceptionally well, and then you've got the rest of the market that is kind of lagged behind. On this slide, we have a quick check-in on valuation here. We've had a little bit of back and forth in the market. We did have a kind of a reset. Basically, earnings were going up, but prices were coming down when we had that sell-off. But frankly, we've seen prices move up kind of almost in tandem here just lately, in tandem with earnings estimate increases. And those estimates are actually pretty bona fide. I never would have thought we'd be talking about high double-digit earnings estimates, or basically year-over-year estimates for the S&P 500, which again is dominated by technology. So that's why we've got that. But I never thought we'd see it, but we are. And these are real earnings that are coming out of some of these hyperscalers and other technology-related firms. But having said all that, with price movements that are kind of pacing that here lately, we're still over a full standard deviation above our normal range. And so that puts us into kind of rarefied air, kind of, I'll call it slightly nosebleed territory from a valuation standpoint. So U.S. stocks, again, are being outperformed by international stocks. Multiples not exceptionally high, but it's just not cheap right now. And it's just a very interesting point. Again, it's very much, the growth in the market is very much predicated on earnings, and particularly earnings within the technology sector. Free cash flow yield. This is a very interesting point. And, we've had some slides here recently talking about the hyperscalers and their capital spending plans. And we've talked about CapEx several times tonight in this chart pack. That's not only is it important to the economy, but it's certainly important to the growth of the whole technology industry. But we've seen in several instances where capital spending is outstripping free cash flow, and this is really kind of in a microcosm. This deceleration here is kind of evidence of that. But what's interesting is that this is not particularly cyclical, that this has actually been in a secular downtrend for quite some time, and it's just taken on a new acceleration here recently with some of the very aggressive spending plans for these hyperscalers. Now we have a couple of data points I thought were really interesting. On this slide, we've got a lot of short interest, very interesting. And so this is the median stock. You can see the rise in short interest here. And this would be the 90th percentile stock, the top tier stock here. And you actually have, overall, these are different, these numbers may look odd that the 8's below the 3, but these are on different axes here. But just suffice it to say that the top tier stocks are witnessing just as much of a spike in short interest as the rest of the market is. And so, what does that mean? So short interest is basically you are borrowing the stock and selling it, hoping that it goes down. And so, this is, to see a spike in this would be particularly bearish on the market, which is kind of an interesting and salient point because confidence actually remains relatively high overall, but you've got so-called, would-be smart money that is betting on a decline in the market. Now, if the market keeps going up, then what this does is it provides the flame to the propellant, and it caused the market to go up even more and accelerate. And we've already seen some of that, and that's highlighted here in the momentum stocks versus the overall S&P 500. So, when prices continue to go up, when you have high short interest rates, that is what they call a short squeeze. And so these people have to exit their position at a loss, and it causes the market to go up because they have to buy the stock back to close out that position. And so, again, I think that's contributed to some of the momentum relative outperformance here. Stock and bond rolling correlation. We've been talking about this a while. It's at high levels. It has been for the better part of a number of years. I'll say that we had kind of a better looking market last year in 2025 when it came to the correlation between these two asset classes. And the fact that this is positive really tells you that the value of the 60-40 diversification play, you've got to think about it differently now. 60% stocks, 40% bonds, but if they're both, I won't say highly correlated. If they were perfectly correlated, it'd be 1.0. So they're not perfectly correlated, but they have enough high correlation that, like, when stocks go down lately, bonds have had a tendency to go down too. And we don't want that. Diversification should help us, not hurt us, not compound us. And so we just have to think about diversification into quote unquote income differently because of the higher overall correlations to stocks. So this is a very interesting chart from Apollo. I just love their research, and it actually breaks down kind of some of the reasons that I think are extremely valid on why we've had an overall increase in the yield curve. And when you look at the curve here, this is basically from last week, but if you go back, perhaps 6-9 months, and you follow my little red dot cursor here, I mean, this would have been like where the yield curve would have been. And so we've had an increase at all yields here. You look at it in this x-axis, ultra short to 30-year bonds. The interest, the yield levels have gone up all along that curve, but for different reasons. Here we've got higher inflation. and the feeling that now that the Fed is going to have to maybe interest rate or raise interest rates before they would ever lower them. Here you've got a lot of issuance by those hyperscalers, by the AI firms to help support those capital spending projects that they have. And then here we have, just kind of a general, kind of a funk when it comes to the outlook for fiscal policy. I mean, we're running huge deficits, we're borrowing, we're increasing the amount of treasury issuance, and I think this probably gets anchored at a higher level over time until we can get to a point of maybe not even balanced budgets, but at least a deceleration in overall budget deficits. But that's the reason why the long end is moving a little bit higher there. So chip demand, we've talked about this. This is very important to the technology industry as well as the overall economy. And like I said, the economy and the market is going to go where technology takes it. And but to that point, this is real data. These are AI accelerator revenues. So, again, you don't see any kind of like, again, just like you're looking for inflection points where like, okay, is the market missing this? Well, right now the answer is no, because you have this tremendous acceleration in revenues. And again, this has been playing out 2023. I mean, this has been playing out almost every quarter except for right here. And it's not just NVIDIA, but you've got Broadcom, which has caught a bid, and AMD as well. So, the AI trade is real for the moment, but the risk is there that you get to a point where maybe this levels off and then kind of comes down a little bit. That's when you see sentiment in this area change. That's where you might see some sell-off, profit taking, and some repricing of that kind of risk. That's all we have for the chart pack this week. Hope you've enjoyed it. Have a great week and have a great start to your June, and we'll talk to you again soon.